Hey, how's it going, traders? Welcome back to mentfx. This is episode 15 of the mentfx masterclass, and today we're going to be touching a little bit on algorithmic trading and also on the group that we have just made. So on Telegram, we officially have a Metafx VIP group. Reach out to me if you'd like to join. Just sent it out to some of the clients that I've been in contact with, that have been watching my videos, that have been asking questions. This morning, we actually sent out this trade right here, looking to clear these equal highs. As long as these held, I wanted to have a trade right under this liquidity that lay here in the form of this 1 minute order block to see that trade significantly higher. So what we had is we had that play out perfectly. We actually had a lot more going on here. We had the fibs open to see that perfect discount area for that perfect retracement. I actually ended up getting in right here on the wick into this fair value gap. So I entered just on the start of that, and I took my first profits just above this high right here. Just above this high right here, actually, as you can see, this little line. So I took some profits here, had my my trade at break even, and we sadly came back down, hitting me out of break even, although I took a small profit before price continued higher, coming back down to that perfect entry that we sent out right at that order block, as you can see, hitting it dead on and then taking off to clear out these equal highs after creating them for one more second, clearing out those equal highs and clearing out that longer term inefficiency where I expected price to come. And then if that wasn't enough, we had price come back up there 3 times, clearing out that liquidity that was created right here as well, until dropping and now consolidating. So if anybody wants to get in on this, please message me on Telegram or Instagram or Fiverr or wherever we've spoken before. But in this one, I want to talk a little bit about indicators and how your approach to trading indicators should be. So before, I've spoken a lot about the fact that when you're trading indicators, the one thing you want to stay away from is the whole notion of stochastics, right? The oversold and the overboughts, the MACDs, right? So you have your MACDs, the RSIs, basically anything that you've kind of learned about online. So if we just go to YouTube very quickly and we just go indicator strategy or something along those lines, if we look up something like this, most of the time, the indicators you find in a lot of these videos and videos like this and videos like this, you see how everything's talking about MACDs, about moving averages and stuff like that, are the indicators that are actually going to keep you stuck. These are the equivalent of learning how to trade support and resistance in retail and expecting it to hold and work in the future and constantly failing, blaming yourself for it and your own emotions and trying to get deeper, okay? So number one is do not trade the indicators that are mass known, or whatever you want to call them, okay? Secondly, understand why you can trade indicators and why you can make money doing that, okay? So when we look at this, for instance, let's actually open this up right here. So this is an algorithm I've been working on. It's a very simple one. It's based on a daily chart, delivers a good amount of pips. Still in the testing phases, so it shouldn't be taken to live markets just yet, but it has shown some good promise. It's ultimately based on 1, 2, 3, 4, 5, about 5 different conditions which allow for you to get into a trade, and they are just 5 different indicators that are very random. So this is an SSL. This is the Heiken Ashes on top of a normal candlestick chart. This is some trend scalp indicator that I found on a scalping program that should be used for a 1 minute scalper. I found this tricks indicator, which I know is used by many, but it was a good one that got me into pretty long trends. As you can see, as we're up, we get into pretty big trends, and it keeps you in them for a while. When it goes down, usually price is moving downwards. So generally, just 5 different indicators that are very random. Although I do not trade this way, I have created multiple algorithms that can be traded profitably and forever if that's something that you chose to do. I just enjoy to trade institutionally. I understand what I'm looking for. I understand how to find my setups, and that's how we trade, right? Hence this setup that we had today, bringing us a 1-to-9, which I actually just got to experience as about 1-to-1 before I got broken even. So even though I wasn't able to trade this the way I should have traded it, this was the overall setup. that some of my clients were able to catch and take. Okay. So back to the original thing. When we look at an indicator like this, what we've ultimately done is we've taken 5 different moving parts of random things, stuck them together, and found a pattern that works over and over again, okay? And this pattern does not change in any circumstance, right? Pattern is as follows. If there is a blue dot, we will wait for, if there's a blue dot, we want this to be above this middle line. We want the Heikin-Ashi candle to be larger than the previous one. And we want this green SSL alert to be above this red one, okay? So ultimately, as you can see, when this blue line formed, although everything was almost intact, this blue Heikin-Ashi was not bigger than the previous one. This was not above, so this was not a trade. And sadly, we missed out on lots of pips here, especially being a daily chart, okay? But I just want, the reason behind this, as you'll see in a second, is because I want you to get ingrained with the idea of trading algorithmically. And that will play a big role in your institutional learning ladder, okay? So what we're going to do is we're going to go back a little bit and just take a look at price right here as it moves up. Let's note all the entries we could have potentially had. So all this starts with the blue dot, so that's the first one. We have a little break here, as you can see, before the next blue dot, which is right here. We have another break right here before the blue dot. Have a red dot right here, so that will be opportunities for sells, opportunities for buys, opportunities for sells, and some opportunities for sells right there as well, okay? So just by looking at this, based on the few parameters I just told you that I want to make sure are present, we can note down the entry. So this, as you can see, was not above. This was not an entry. Let's delete that. Blue, blue, blue. Well, I mean, above, blue, bigger Heikin-Ashi, this would be an entry. Blue, it's above, bigger Heikin-Ashi, this would be an entry. Red, not below, this is not an entry. Green, blue, it's above, it's bigger, this would be an entry. Red, not below, this would not be an entry. Red, below, red, of course, and the bigger Heikin-Ashi, that will be an entry. And this blue, with this not being above, is non-entry, right? So just within this span from 2017 06 22 to this time right here, 2017 11 02, so about a year, we only had 4 trades, okay? So your algorithms can of course be built on daily charts, hour charts, even on the minute charts, right? There are people that can make a ton of money creating scalping algorithms, which is something that I actually do have. I created a Renko based scalping indicator that that backtested has returned about 50% each month, but again, it's based on 15 pip. No, wait, sorry. It's based on 30 pip take profits and 20 pip stop losses, right? So it's very small scalp based indicator that, of course, if you just ran, you could make money. But the point is, when you learn to approach entries in a way like this, you take away every emotional aspect of trading, right? So imagine this buy right here. There's nothing more that you need except for this confirmation that everything's a buy and then an entry. What is the entry based on? Well, your stop loss can be based on an ATR, right? It could be the actual ATR, so 50 pips, or it could be more than that, like 100 pips, so double the ATR, or it can be 1.5 times the ATR. And then your take profit would be, let's say, 1 times the ATR plus a trailing one, right? So if you entered this actually went down 100 pips, so you probably wouldn't have gotten stopped. So let's count that as a stop trade. That's, let's say, -1 RR, okay? You get into this buy right here. Heikin-Ashi is bigger. Everything is perfect as we have it highlighted. The ATR here is 57 pips, okay? So let's delete the Heikin-Ashi very quickly. Recognize this would be the entry. 57 pips is right here. So as you can see, that stop loss never got hit. And then price ended up moving about 230 pips. So just on that, you've made 4 RR, right? So you've easily made this back. But again, your take profit could be based on 2 times the ATR. So you could be a 1 to 2 or 1 to 3 trader every time. So let's say it's 1 to 3. You'd be up 2 RR total on both these trades now, okay? As you're up 2 RR, waiting for the next setup. The next setup presents itself right here, as you can see. At this time, the Heikin-Ashi is bigger. We don't have to open that, but it is. Just trust me on that. And we could be taking a buy here. We look at the ATR this time, it's 65 pips. So if we entered this, 65 pips is right here. So that was never hit. So your take profit would have been, of course, that's 65 times 2 or times 3 based on what you wanted. So 60 actually hit at times 2. So it did go up to 130 about, and then it began to drop. So either you got broken even here or you took profit at 1 to 2. Either way, let's say you didn't, and your RR would still be +2. okay? You get a sell here, whatever it might be. Your ATR at this point is about 54 pips. I'm pretty sure this will get hit. Yeah, so 54 pips gets hit here. But again, if that was 100 pips, never got hit. If it was just double, and it came down to 163, right? So on and so forth. The idea behind something like this is that you've created an algorithmic approach to price. You've taken away every emotional aspect. Your trades will be based on exactly what I just did. I go blue, confirmed, confirmed, entry. Your stop loss is decided. Your take profit is decided. You know when you're moving to break even, whether it's at 1 times the ATR or something like that. And you've created a mathematical approach pretty much to price. This is important because it's the baby steps, the crux of setting up a system, even institutionally trading, that can help you manage your risk and your price and your trade correctly. So something like this that, okay, what we have to recognize about this is when I took this trade right here, okay, I could have held it, and then something like this could have happened. Okay, and if this happened, I'd be down 1 RR. Okay, this right here, if it got hit, we understand we'd be down, let's say 1%, because we risk 1% on our trades. Okay, now on the other hand, if I took profit above this high, recognizing that above swing highs we have liquidity, and then had my thing at break even, or had my trade at break even right here, then what would happen is this trade would now be worth just above here would be 3.6, so a little bit less than that because the trade would actually be right here. Boom, boom. So it's about 1 to 2. So we take off half percentage off that. So we take off 1%. So what happens is we'd actually be 1%. And when that gets stopped out of break even, we've made 1% within, if you think about it, literally less than an hour, we've made 1% on an account and we've locked in profit. Why is something like this very important? Because we now have an algorithmic approach to managing a trade. And when you have something like that, your winnings could sometimes be very small, but then break even, or they can be extremely huge and you don't even have to worry about it. It becomes relatively risk-free when you take a trade like that and can manage it properly, okay? So today, when we took this, of course, we based it on an algorithmic approach. I had someone message me and ask me, how come, why are you using the 1 minute to see the order blocks? Are institutions even involved on the 1 minute chart? Why would you be taking this order block, like understanding that it would most likely respect it to come higher, right? So it's like we sent it here. Why would you be expecting this order block to be the one that holds if none of this stuff holds? Well, because if you think about what we've been talking about thus far, with institutions being the market makers or whatever, moving this market to areas of inefficiency and price, those areas of inefficiency are not areas seen by the traders, usually. These areas of inefficiencies are the inefficient areas and these order blocks and areas of liquidity that are seen by the banks or by the people that have coded these things. Because the approach when you're working in a bank is actually algorithmic. There's usually no traders on the back end of this selling into this, trying to grab your orders that rest below this. In reality, it's a computer that has code running that is selling here because it knows there's orders that rest below this in the form of stop losses and sell stops so they can take profits and enter trades before hitting that final area, as you can see, of inefficiency to then go higher. Where does that price move higher to and how does it move there? Notice this. Price moves higher, creates that area of liquidity. Why is this liquidity? Well, notice this. This will start looking like what to most retail traders or emotional people? It looks like they'll want for price to go where? Lower. Look at this. We have a trend line forming. All this stuff is starting to play into their minds as an ability to go short, when in reality, price takes off rapidly. Okay, where does it make its way to? Just under this area of what? Resistance. What do people expect at areas like this? Right, we come up there one more time, boom. We start moving down. What are people doing? People are consistently piling in the sell trades in all these areas and all these areas and all these areas. When they do that, what does the algorithm understand? The algorithm might not see where all the orders in the market are, but the algorithm knows that above all these highs lays what? A ton of people that have stop losses here and have buy stops because people are starting to anticipate this area as an important area. So when people start selling this, the market maker comes in and can force price right through that top to come where? That higher area inefficiency that we were looking at earlier, to get filled, which is also the form of this order block. Okay, so we fill that, we come down, we come back up. Okay, what do we create again? Liquidity here. Then what do? We come down, hitting the order block in here, or this one, we don't know. We're not actually trading this, we're just watching it to understand it. Hitting that order block, as you can see right there, this main one, and trading higher to where? Well, we understand liquidity lies above here. Notice what we do. We stop here again, doing what? Creating what looks like a trend line. Again, same stuff over and over again. People are selling this, and we come right above it without a problem, taking all that liquidity, and then we break down lower. Okay, where are we most likely breaking down to again? Right here. So I'm most likely going to see price come up, fill in this area right here, and then come lower to here, create that resistance, and then do what? Drop even lower to this longer term area that has not been filled yet. Okay, so this is how the algorithm that institutions employ look at price. So yes, the 1 minute matters, even the 5 second matters. We don't see some of that stuff. We can't really get that low. Well, we have a 1 second chart, but I can't get on it because I don't pay for TradingView. But the idea is every point matters. Why was this order block the one I wanted to enter on? Because I recognized that one, we should have filled this, which we did, creating liquidity, then moved into it to mitigate this final area. Okay, it's important because prices are approached in an algorithmic way from the institutional side. Okay, so why would you think that an algorithmic way of trading wouldn't work for you? Okay, so there's people out there that will trade literally this way, looking to take trades using the ATR or doing the same stuff on a 1 minute chart. Maybe this is their entire concept. They want to buy, right? These areas, boom, right here, they want to buy. We have blue, we have the above. They enter right here with the ATR, at this time being 4 pips. So they enter on this. The 4 pips never gets hit. This is the 4 pips, as you can see, and it goes up 14 pips. Okay, and that's already a 1 to 3, or a little bit more than that, right? And all we did was we created an algorithm. The reason I wanted to make a video on algorithms is to explain to the people watching that there is no correct way of trading. There's a ton of ways and strategies that you can employ to trade. I don't believe that you should be using the strategies that are employed by all the people, aka support resistance, emotional kind of based trading, RSIs, MACDs, all that stuff. But if you go out there and pioneer yourself 5, 6, 7, 8, 40 different indicators, test them all to come up with 4 that match pretty well to give you what appear to be good entries, and then refine that to an entry that's always the same based on ATR, then what you do is you create an algorithmic process in your head. So when you approach something like this and you start to want to get involved with institutions and trading the institutional way, looking for these crazy 1 to 9 setups with no issue, you understand that you're not just holding this entire trade. You're understanding how you're mitigating it. Instead of taking a stop loss based on ATR, you're always taking a stop loss based on that order block or that inefficiency or that breaker block. You're always taking your first profit based on what? The area where banks would want to exit first, exit again, and then finally exit. Okay? Now, sometimes you should watch the risk management video if you want to get deeper on this, but you could be exiting above the equal highs, recognizing that you were setting up this move to get above this. This would be your first exit right there as price just barely gets through it. And then you'd be holding until this area here. Okay. Or as we've spoken about before, you could be holding on a trailing stop type of way. So you could have taken off some of your position here at 1 to 6, and the rest you'd be under this low. As the tops get broken and structure continues higher, we can mitigate up to this low right here. Notice how structure never breaks higher. We wait. So now we can watch if price ever gets down there. Price does not get down there. Then we have a new structure break right here, which is again under this low. So we can really just mitigate just down to here if we'd really like to. And now we're just here, right? But now the cool thing is if price does want to go higher and breaks this, now we can mitigate even higher. And if price does keep going significantly higher to, for instance, order blocks in these areas and in these areas, guess what? This tiny trade that has just made you 1% and you've taken off your 50% can now, with a proper trailing stop, make you an extra half of this because you took off half, can make you an extra 7%, can make you an extra 10%. And again, if something crazy happens and the price just decides to move exponentially significantly higher, you can keep mitigating up until it finally gets stopped at 15%. This is how we trade when we trade institutionally. We also trade in a way that understands how price can move algorithmically. That's why we take trades off partially at some areas, because we understand the algorithm is targeting this high at first. Now, when the algorithm gets to that target, there's no saying that the smart money algorithm won't take price significantly lower, right, to that bigger order block on a higher time frame, which is right here, right, before coming to clear out all the liquidity that would rest in this case above this high and these highs right here, right? So that's why we take partials, because we have to recognize that we are not always going to be in their footsteps and we will not always know what they're doing. But when we take those partials, we ultimately make a trade risk-free. And now if the algorithm does continue to make those areas of liquidity and then grab those areas of liquidity, then create new areas of liquidity to then do what? Grab those areas of liquidity, we can start to take partials the correct way in an algorithmic sense, okay? So the point of this video was ultimately to share the setup with you that we were able to catch in the group, to tell you guys that there is a group now and that I still do the one-on-ones for those that are for those that need it. Although I tell everybody that with enough study and dedication, you can learn everything you need to do or learn just watching the videos. But some people need that extra one-on-one. An algorithmic approach to the market is a good way to make money and is a profitable way to make money. There is nothing wrong with it. Learning to do something like this can be basically the end goal for you. Creating something that works in the form of this, right? And you just scalp higher from an hourly chart or whatever it may be, can be all you need to become profitable in the Forex market. And it's fully plausible. But the point of this video was to explain to you that you can use certain things that can get you into trades, okay? And when you trade algorithmically or learn how to make something like this, your brain gets accustomed to understanding price in an algorithmic way rather than a psychological or emotional way. So when you get into trades like this, instead of just, being scared and taking profit here, you recognize that if banks or institutions want to take price higher, the algorithm is most likely, or 100% of the time, going to take it to the first area that makes sense before coming lower or before coming higher to take those higher areas in an algorithmic way. And that's why we had this higher area in mind, which is why, as you can see, we've mitigated it a few times, finally mitigated it one more time, and now it looks like we're breaking down significantly lower. Okay. So thank you for watching. I hope this made a lot of sense. This is an algorithmic approach to the market. This is why indicators can, and in some cases should be employed alongside your journey to becoming an institutional trader and understanding how to trade properly. So thank you for watching, guys. This was mentfx. If you guys have any questions, please leave them in the comments. Please contact me on Telegram, Instagram, or Fiverr if you want to get in on a one-on-one or into my group. Other than that, I appreciate all the support. It's insane how fast we've been growing, and I wish you guys a good week. Thank you.